Welcome to Inside Automotive with Jim Fitzpatrick.
Hey everyone, Jim Fitzpatrick. Thanks so much for joining me on another edition of Inside Automotive right here at CBT News. Joining us now is Kevin Tynan, Director of Research at the Presidio Group. Kevin, thank you so much for taking the time out of what is a very busy summer for you. I know you crisscross the country speaking at so many different association meetings and conferences and such. So thanks for taking the time with us. We appreciate it. Here we are in the beginning of July. So talk to us a little bit about June sales. What are some of the things that jump out at you?
Yeah, I would say when you look at the volume, the seasonally adjusted rate, probably not super impressive, especially compared to earlier in the year, March and April, where you had this tariff threat. But I'm kind of more focused on the pricing power and the margin integrity than the volume number. So for me, I look at it where, hey, if it's a 15, low 15s, and the manufacturers aren't overproducing, which it looks like they're not, to me, that means that we have a reasonably organic, firm price, reasonable margin kind of market going forward. And I think that's better for the industry, for retailers. And I get it. Retailers see opportunity in more than just the new vehicle sale. There's other benefits to creating a buyer, whether it's in finance and insurance or as a service customer or
Sure.
whatever it winds up being. But ultimately, to not be oversupplied, have some firm pricing and visibility going forward is not a bad thing for the industry.
No, it's not. And we've talked about that before in terms of lower volume and higher gross profits and such for more of a healthy, profitable dealership overall. And I don't think dealers have a major problem with that, right?
Yeah.
I mean, if they're not chasing a
definitely.
17 million SAAR, which, as we talked about before, I'm not so sure how important that is as
Right.
it is to the dealer versus the OEMs, right?
Yeah, and that's interesting because then in my travels in the past month and talking to a lot of dealers and other industry, watchers, it seems like, or it feels like the industry is not chasing market share for the sake of market share anymore. Obviously, there are a few that are oversupplied and will have to do that. And it may be in small pockets of nameplates specifically. Some models aren't selling as well. And it's inventory management at the end of the day. But, there would always be this threat, or somebody would always bring up to me, oh, all it takes is one bad actor to chase market share, and then
Right.
everybody jumps in and it's this price war race to the bottom.
Sure.
And it feels like it's not that kind of industry anymore, where manufacturers have gotten a little bit more discipline on production. And maybe that's the lesson learned from that value of scarcity during the pandemic period, but it doesn't look like there's this rush to run the factory 24/7
Yeah.
and just choke the dealers with inventory. So it feels a little bit different in that sense. I will say, though, the concern you have is if there is that production discipline, that production capacity still exists. And at some point that has to be dealt with because it's costly to run your factories below 80% persistently. And
Yeah.
I think at some point those costs have to be rationalized.
That's right. That's right. Maybe they can build a little cheaper car with that extra time on their hands, right?
Yeah, and that's an interesting concept. And I've heard a lot of people talk about that this summer. And I guess it depends on who you are as an automaker. If you look at the domestic manufacturers who have really moved up market and that mix shift to truck from car, where your average transaction price is in the low to mid $50,000 range, I question, what does creating a low content $20,000 vehicle do for you other than lose money? And it feels a little bit like putting your worst foot forward, where you're putting a stripper out there for $20,000, and then what's next, right? You're still not profitable to up to close to $50,000.
That's right. Yeah, what did you win?
Yeah, so right. So, what's next for that consumer? They're still unprofitable for you in the low 30s, probably even into the 40s. So you get a customer who, even if they do like the product, you're still going to be married to an unprofitable consumer for 2 or 3 more purchases. So it's an interesting dynamic, but I'm not sure it works for a lot of automakers.
That's right. That's right. So what will this mean for with the numbers coming in now for June? what does it mean for Q3? I mean, if you had to give a forecast here,
so I think we are the back half of the year probably looks more like May and June in a 15 range, which again is not a bad thing.
Yeah.
What it does though, if we're talking about that volume being a reflection of pricing power and margin, it means that affordability isn't coming back.
Yeah.
You know, maybe there's a couple of brands in there that are aggressively discounting just to get inventory in control, but once it's there, you know, I would expect that the domestic brands, those dealers, they're not coming back down market. And this was kind of my message through the summer was, you know, don't expect that, right? Those, you know, your Stellantis brands, your GM brands, the Ford brands are not going to get less expensive. If they are in control of their output and their inventory, it's only going to go and be inflationary in that sense. The other thing, or where I think the deals will be with EV subsidies or tax rebates or whatever winds up happening, getting cut off, and maybe sooner than people realize. That could be the end of September instead of a stair step down. That could be a chop all at once.
Yeah.
And you're going to see this mad scramble, which I think has already started, for aggressive lease EV deals or cash on the hood or low rate financing. I think what you might see is a sort of false narrative that is EV sales are surging, but it's really just not getting caught holding the bag if you're a dealership for when those incentives go away. Essentially, if you think about the $7,500 federal tax credit, it would be an instant increase by $7,500 in the price of the vehicle.
Sure, no question. And much the way we saw the latter part of March, you spur a lot of activity in sales due to the threat in early April of tariffs hitting. We're going to be seeing the same thing now with the possible loss of the $7,500 a car on EVs, where this actually might clean out the shelves of EVs at dealerships, right?
Right, but I would be careful not to interpret it as strong demand for that product. I mean, I think when you're talking about sub $200 a month leases with, you know, there's obviously some money to put down there, but, you know, still, if you calculate it out, 24-month leases are under $400, and where you look at average payments are these days, that's, you know, probably half of what people are expecting to pay.
That's right.
You know, so I would just be careful that that's not a legitimate signal of demand, other than consumers looking to buy that kind of deal. I would not expect it to be sustainable going forward. But, you know, post that period, I think for the first time, probably ever, in late 25 and into 26, we will see what the EV market organically actually looks like.
That's right.
If those federal and state subsidies and incentives go away, we'll have a pretty good idea of what that looks like. I mean, we know what profitability or the lack thereof looks like for the manufacturers. We'll see, I guess, a better gauge of where organic demand from the consumer actually is on those products.
And the same holds true on the used car market for EVs, right?
Yeah. I mean, I think you have a little bit of the unknown of what a used or high mileage battery means versus what we've traditionally considered, you know, a high mileage car. Okay, so 100,000 miles on an engine, an internal combustion engine, isn't as scary, obviously, as it used to be. But I think people aren't sure. I don't know that we have real good testing techniques or pre-purchase inspection methods that can say, here's the health of this battery. I'm sure it's out there, but, you know, I'm not sure the average consumer understands what that looks like. So those products may be a little bit scary for them. And then on the other end of it, even if you are confident in those kinds of diagnostics, repair is going to be significantly a different financial burden than what it would be for an internal combustion vehicle. You know, when it may not go as frequently, you might not have as many of the little problems, but the big problems are everything.
That's right. It is amazing. You and I have been talking now for years, and we've seen this whole surge of EVs where the whole industry is going, we're going all in on EVs. And of course, the laws were out there that said by 2035, it's going to be all EVs in certain states. And now we see that go away. We see the $7,500 going away. We see it all going away. Manufacturers have made a complete 180 on this EV situation, right? And this is all within like the last 3 years, maybe something like that, right?
Yeah, it is incredible. And I actually, one of my stops was a conference with some very smart and connected people in terms of China, in the back of my mind, and there's a couple people I discussed this with that kind of agree with me, is, the not that the move to electrification was bad, but it feels like we were doing it at China's pace or trying to keep pace. And on the one hand, you hear all the time that it's a race we can't win. China has put electricity as their focus for decades, right?
Yeah,
They control the supply chain, the mining, the processing of
sure.
the minerals. They put this in place over the course of decades because they didn't want to be beholden to oil, to petroleum.
Yeah,
So they can do electricity. So it makes sense for them to make their transportation and commercial and passenger to be electric.
yeah.
And I feel like we got caught in this mindset that we're falling behind technologically, but it's a move I'm not sure we definitely needed to make or to make at the pace of China, right?
Yeah.
So why not be good at the game we play, which is internal combustion vehicles powered by gasoline, and then we move towards electrification as it makes sense for our market, rather than jumping in with both feet on something that we don't control. So now we can't control pricing and cost. So it winds up not being profitable for us. And we're trading essentially that dependence on foreign oil to dependence on China's minerals and mining and processing and their supply chain. And, I'm not sure that that's a good
But
trade.
don't you think this was all driven though by a certain element in government that said we got to go clean energy, and I'm going to be the hero, the knight in white knight in shining armor that's going to bring clean energy, and we're going to have clean air, and this is going to be good for the environment, and we're going to put these things into place without any real, right?
Again, how in the early days and even now, how are we powering these things, right?
Yeah.
So we're not using a whole lot of renewable. I mean, and again, that's to my point, is maybe we'll get there over time
Yeah.
at a more reasonable pace. But if we're powering electric vehicles with coal, ultimately at the end of the day, we're just moving the air quality or
Exactly.
lack thereof from one country to another or one state to
Yeah.
another. And it feels like, again, it was rushed to the point where, yeah, we will develop these technologies over time. But to put a deadline on it or force automakers to do unprofitable things very quickly, it just seems like we're playing right
Yeah.
into the strengths of our opponent, which is to go electric very quickly.
That's right.
And I don't know that was totally necessary. We can absolutely get there. But the irony is that everybody who tells us we should be doing it also tells us it's a game we can't win. We can't keep up with China, their pace of innovation,
Right.
their labor force, their industrial policy, all these things. So why are we even playing that game?
That's right. That's right. And when we interview Michael Dunn, who is a foremost authority on the China auto industry, he says we are on an island on this planet, and China and EVs are everywhere except here in North America. And but they're coming. I mean, these cheaper.
Yeah.
We've talked about it before, right?
Yeah, and I saw Michael at the China
Yeah,
event.
I'm sure you did when you mentioned you were there.
Yeah, and what was interesting is, and my sort of point is playing devil's advocate is, so if China isn't doing EVs in the US and Canada, so what? Right? Like, it's not like we have our manufacturers have over too much capacity of electric vehicles. We're trying to jam them into Europe and we're losing.
Yeah.
Or to jam them into China and we're losing.
Right.
We're not.
Right.
Right. So we're doing what we do here. And I don't understand the problem with continuing to do that well. And look, if we're a pickup and SUV market,
Oh, yeah.
and automakers have focused on the North America markets and are very profitable doing it, and have retreated out of China and out of Europe because the demand profile there doesn't match what we build here. I'm not seeing where that's, a complete failure. I think, again, we can move in those directions at our pace, but let's do what we do well while we're doing those other things.
Yeah.
And that's ultimately, I think, what happened if you think about Europe, right? And China builds a lot of capacity for electric vehicles. They satisfy their domestic market, but there's still too much capacity. So now you go to look for markets to put it in, and they wind up winning in Europe, and they wind up winning in other emerging markets or mature markets. But we're not necessarily competing head to head. Our domestic manufacturers got out of a lot of those markets years ago because they were chronically losing money for them.
Yeah, it's a good point. That's a good point. So don't hit the panic button just yet.
I mean, if you're making money doing what you do in North America and your operation is right sized to be that in that region and do it profitably, okay, and then we'll invest in some of these other technologies as we see necessary. But I don't know that the rush is really there to throw out the baby with the bathwater and then at the flick of a switch say we're gonna get rid of this 100+ years of technology and do this thing which we don't lead in, which we're not good at, which we don't have the supply chain set up for, which is expensive, which is unprofitable. So it's an interesting problem, and we'll see, I guess, how it plays out over the next couple of years.
Hey, this is a question that just as an economist, that I mean, you worked at Bloomberg and now for the Presidio Group, and you're in that community for sure. Does it surprise you that the stock market is doing pretty well right now in light of all of this uncertainty out there with tariffs and interest rates and gas and?
Yeah. Well, look, I don't pick stocks anymore, but I do think about this, that when you look at the different ways to play the auto industry, I mean, it is, and not just now, but for a very long time, even when I started in this industry, I feel like the manufacturers are a very difficult place to differentiate them, to pick a winner. I feel like it's this basket of companies that basically do the same thing.
Yeah.
That are essentially subject to the same macroeconomic conditions regionally, wherever they're producing. And I don't want to call the space uninvestable, but if you look at the returns of automakers over time, they're not great, and even if you consider a Tesla, like the way it whipsaws in terms of its valuation, it spikes, it plummets,
Unreal.
It spikes, it plummets. It's a nerve-wracking place to think about in terms of investing. And then there's other areas. The suppliers are difficult too, because they're always beholden to cost cuts and what their OE partners are trying to do in terms of production volume and guarantees and things like that.
Yeah.
The dealerships, and we've talked about this, I feel like is the undiscovered opportunity. Essentially, you're talking about 4 businesses under one roof.
That's right.
Whether it's new, used, parts, service, finance, and insurance. And there's that ability or revenue diversity. And it's a nimble, resilient group that can kind of go where
they pivot. I'm not getting new cars, I'll sell used cars. I'm not getting either, I'll go to fixed stops and collision. It really is. You're right. And
the other one that I've found interesting that has done well when you look at returns in the stock market that doesn't get talked about a lot is the retail auto parts companies. If you pull up a chart of an AutoZone or an O'Reilly's, over time, way better return from those companies than you would see from manufacturing, right? And manufacturing, which historically has always been a high volume, low margin market. Some of these other places have been way better opportunity. They just don't get the headlines. They're not, the stories just aren't as sexy as talking about a Tesla or even a Ford Motor Company or GM or Stellantis brands. But from an investment perspective, it's a very difficult, almost perplexing way to think about making money in the markets as related to the auto industry.
Yeah, there's no question. It's I saw a report that Brian Benstock had shared with us here at CBT News, and that business is just skyrocketing, the parts business, and is just continuing to grow. in the billions and billions of dollars. It's been really something. And
that it's an interesting business because I think it's sort of counter-cyclical in the sense that, if the new vehicle market is slow, people are holding on, right? We're seeing average age of vehicles go up, right? Repair, maintenance. And there's also the part where people want to buy chemicals, do their oil changes.
That's right.
But also clean, interior, exterior, do some detailing, right? So there's a lot of components of that business. But even in that situation where people are buying new or not buying new and holding on longer, in the periods where they are buying new, you figure they're just replenishing the fleet anyway. And that may be 5, 6, 7 years down the road, but you're just backfilling, the registered vehicles somewhere near 300 million in this country, and people will need parts and chemicals for those things going forward. So it's almost like there's not a bad time to be getting involved with retail auto parts, because you're either building the fleet for 5, 7 years down the road, or you're addressing aging vehicles today.
That's right.
Just philosophically interesting space.
That's right. I'm going to go buy Pet Boys stock now after this conversation.
Well, now you can't, not anymore. You can, what are the publicly traded ones?
Maybe AutoZone then. I'll find one of them, right?
Auto parts. Genuine parts, they're out there.
That's right. Kevin Tynan, Director of Research at the Presidio Group. Thank you so much for joining us on the show. Very much appreciate it. I know our dealer viewers get a lot out of your time here, so appreciate it.
Thanks, Jim. Happy summer to you.
Yes, you too.
Thanks for watching Inside Automotive with Jim Fitzpatrick.